Hello, everybody. This is Eddie Gabor. I am the co-founder of Key Advisors Group. So today, the hot topic is the Fed. As Mr. Powell is in his testimony today, everyone's trying to get an edge on whether they're going to be dovish in what they say or if they're going to be very hawkish in what they say. There's some reports out that people think that the Fed is going to raise rates 4 times this year, okay? I want to share with you our thoughts in regards to the Fed. And we don't know whether they're going to raise rates 4 times, 1 time, 2 times, but let me give you our opinion on what we think in either one of those scenarios. First, let's address the 4 times in 1 year. I have to tell you, it is our opinion that if the Fed raises rates 4 times this year, while the economy is slowing down, while they're taking money out of the system in regards to their bond purchases, we would expect to see a massive correction in some of your higher risk assets. We just feel that's too aggressive of a stance to take from a monetary policy perspective. I mean, think about it. You're going to go from buying bonds and keeping rates really low to now not doing that and raising 4 times in 1 year during an economy that more than likely is going to be slowing down in 2022. So I have to tell you, if that is the direction that they go in, from a firm standpoint, we are not only going to be playing defense, we'll probably raise a decent amount of cash from a portfolio perspective and see what happens from a market standpoint. Because again, I don't think that is a scenario that people truly realize what it could do to asset prices. So when someone says that 4 rate hikes are priced into the market, I will respectfully disagree with that, because if we do get 4 rate hikes, I think the volatility that we've seen now is absolutely nothing. I think you'll see a VIX well north of 30 if the Fed were to raise rates 4 times. Now, again, that's my opinion. I don't know what they're going to do. No one knows exactly what they're going to do. But I think the problem that they have put themselves into is because they didn't raise rates last year, when they should have, in our opinion, when the economy could have taken it, when the market could have taken it, now they're where we don't want them to be. They're in a corner and they have to raise rates or tighten faster than they would like to because of their concerns with the labor market, because of their concerns with inflation. So now let's talk about if they take a little bit more of a dovish stance and they raise rates 1 or maybe 2 times. Personally, I think if they were to raise rates 1 time or 2 times this year, that the market could probably handle that. We still expect to see volatility really pick up, but absolutely nothing like a 4 rate hike year, okay? And again, you have to look at the dynamics of what we're heading into, right? If we're going from an economy that's on fire to an economy that's going to be decelerating, you have to be careful with how aggressive you remove the punch bowl from this loose monetary policy. I think at the end of the day, one thing that we probably all agree on is that it's going to be a volatile year. And maybe you don't agree with that, but we feel it's going to be a volatile year. It's just a matter of how volatile it's actually going to be. Because the difference between 1 to 2 rate hikes from 3 to 4 rate hikes is, I would say, way, way, way apart in regards to what type of volatility we'll see. That 3 to 4 rate hike scenario, it's going to cause stomachs to turn. It's going to make the volatility we've seen so far this year look like absolutely nothing, in my opinion. So that's why the Fed is going to they're in a tough spot. Mr. Powell knows how the markets are going to react to that. I think he knows. Now, of course, they can't just worry about the stock market, but at the end of the day, I find it hard to believe they don't watch closely how it reacts to comments and actions that they make. So 2022 is going to be an extremely challenging year for investors because there's so many different mixed signals the market is giving them. There's so many different opinions in regards to what the Fed was going to do, again, versus last year. Last year, the Fed said, hey, no rate hikes, no nothing. So it was kind of like they kind of gave you the clear signal in regards to monetary policy staying very loose. And now that party's over. So regardless of the scenario, the best advice I can give is make sure you have a sound risk management strategy. You understand the risk tolerance that you were willing to take and the volatility you're willing to take. And be very, very active because, again, I know we have pivoted a lot over the last several weeks because of these mixed signals, because of our market thesis. So at the end of the day, no one knows whether their trade is going to be right or wrong, but you just have to do the best that you can and navigate in a market that's going to be extremely challenging. And, we're just big believers in not trying to make one big bet, because in case you're wrong, you can get whipsawed and lose a lot of money, okay? But the clear message I want to give you is, without question, in our opinion, if they are very aggressive in rate hikes, we think the highest risk assets have a chance to lose a substantial amount of money on a percentage basis. That's not to scare anybody. That's just the reality of what would happen if the Fed got really, really aggressive in tightening and our economy slows down. So we'll have to wait and see what happens, but because of the news today, I wanted to make sure I got that out to you so that way you're prepared for either scenario, okay? Have a great day and hope you make this a winning week. Thank you very much for your time.